Today is Monday. I'm recording this hours before the US market opens, and something is breaking in silver right now that shouldn't be possible. A 55-cent arbitrage gap between New York and Shanghai. That gap should close in seconds. Traders see it, banks exploit it, metal moves, prices equalize. But today, the gap stayed open, then widened, then stayed open for hours. This isn't market noise. This is structural failure. What you're watching is the physical silver market in Asia breaking away from the paper silver market in the United States. The great decoupling. Happening live, right now. And by the time New York opens in a few hours, one of two things will happen, both of them explosive. Let me show you exactly what's coming and how to read it. Right now, at this exact moment, New York silver, $32.60. Shanghai silver, $33.50. That's a 0.55 premium for physical silver in China. Here's why that matters. In a normal market, arbitrage traders would 1. Buy silver in New York at $32.60. 2. Sell it in Shanghai at $33.15. 3. Pocket the 0.55 difference. 4. Repeat until the gap closes. This happens in seconds with modern trading systems, but it's not happening. The gap has been open for hours. Why? Because there's not enough physical silver in New York to ship to Shanghai. The plumbing is broken. The system is clogged. Shanghai isn't trading paper promises. Shanghai is trading actual metal, bars, inventory, immediate delivery. New York is trading contracts, leverage, paper IOUs. When Shanghai pays a premium and New York can't respond, that tells you everything about supply. There isn't enough physical silver to satisfy demand. Here's what banks tried to do between midnight and 6 a.m. They smashed the price down, hard. Sharp drops, fast candles. Classic suppression tactics. It didn't work. Every dip was immediately absorbed by battery manufacturers securing supply, electronics companies locking contracts, Asian industrial buyers treating silver like oxygen. This isn't retail FOMO. This isn't Reddit excitement. This is procurement panic. These buyers don't chase price for fun. They secure supply because they see something coming. Delivery schedules extending, contract terms tightening, premiums rising across Asia, inventory drawdowns accelerating. They feel shortages before headlines report them. And they're buying like their production lines depend on it, because they do. That's why Shanghai stayed elevated. That's why selling pressure vanished. That's why the gap refused to close. This is the moment paper loses control. Let me walk you through both paths and how to read which one we're in. Scenario alpha. The gap close, 70% probability. New York opens and immediately gaps higher to $33.15 or above. No hesitation, no slow grind. The price jumps to close the arbitrage. What happens next? Momentum traders flood in, shorts scramble to cover, algorithms flip, bullish $33 becomes psychological fuel, not resistance. From there, $33.50 comes into view fast. That's where industrial fear becomes visible in price. That's where procurement desks panic. That's where delayed orders become emergency buys. This is how price moves vertically, not from hype, but from supply urgency. Banks attempt one final trick at the open. They push price down aggressively. A sharp drop to $32.20. Fast, scary candles. Headlines scream, silver breaks down. The goal? Shake out weak hands, trigger stop losses, create the illusion the breakout failed. Here's the tell that it's fake, volume. Physical buyers don't sell on low volume dips. They buy them. The bounce comes harder than the drop. Why? Because the same forces holding Shanghai up are waiting underneath New York. Any fake out gets absorbed, and when it snaps back, it snaps violently. Here's your roadmap for the open. Bullish signals. Volume above 15,000 contracts on upward moves. Real institutional buying. Price holds above $32.80. Previous resistance, now support. Gap opens near $33.15. Market acknowledging Shanghai's price rebounds are fast and strong. Physical demand underneath manipulation signals. That will fail. Price drops on volume under 10,000 contracts. Paper games. Dips get bought immediately. Physical buyers waiting. Each bounce higher than the dip. Suppression. Losing effectiveness. Shanghai premium stays elevated. To key, New York can't break the physical bid. Either way, direction doesn't change. Only the path. Look at the $32.50 level. For months, that was resistance. It rejected price over and over. That level just flipped to support. Markets don't casually flip resistance into support. That happens when demand overwhelms supply buyers step in earlier with more confidence. The supply-demand dynamic fundamentally shifts. This aligns perfectly with what the arbitrage gap is showing. Physical demand is pulling the market up. Paper is chasing from behind. This is why volatility isn't weakness here. It's evidence. Silver isn't just money. It's a critical industrial input. Solar panels, 100+ million ounces per year. Electric vehicles, growing 20% annually. Electronics, non-negotiable in modern tech. medical equipment, antimicrobial properties, no substitute. Here's the problem. These industries don't have flexibility. They can't switch to aluminum or copper. Silver is irreplaceable in their applications. When inventories fall, they don't negotiate. They pay whatever it takes. Recent data shows COMEX deliverable silver down 15% year over year. Asian premiums elevated for 6+ weeks straight. Delivery times extending from 2 weeks to 4 6 weeks. Contract terms shifting from price per ounce to price plus premium plus rush fees. These are supply chain stress signals, and supply chains don't wait for confirmation. They act first, ask questions later. This is why overnight suppression failed. Paper selling met physical buying. Physical won. Many traders are conditioned to expect silver to fail, to get smashed, to disappoint. Banks know this. They rely on it. Fear sells faster than logic. But conditioning only works until it doesn't. When physical shortages are real, suppression loses effectiveness. Because you cannot print metal. Paper can expand infinitely. Physical cannot. When that reality hits the market, price doesn't adjust gradually. It snaps. This is the heart of the great decoupling. $33 is psychological. But $33.50 is where industrial fear becomes visible in price action. That's where procurement panic shifts from quiet to obvious. Supply chains start bidding against each other. FOMO moves from retail to institutions. Price discovery accelerates exponentially. Above $33.50, silver doesn't tiptoe, it runs. Historically, when silver breaks through industrial fear levels, moves happen in days, not months. 2020, $18 to $30 in 5 months. 2011, $30 to $49 in 3 months. 2008, $17 to $21 in 6 weeks. We're entering that phase right now. If you're holding physical silver, this volatility is confirmation, not a reason to panic. The arbitrage gap validates your position. If you're watching silver miners, this is where leverage matters. When price discovery accelerates, miners move 3-5x faster than the metal itself. If you're trading paper, discipline is everything. Don't confuse noise with direction. The 3 facts that don't lie. 1. Dips are being bought. Physical demand underneath. 2. Premiums are rising. Supply is tight. 3. Arbitrage is broken. System can't deliver those 3 facts together tell you supply is tight. And when supply is tight, price leads. Silver has lagged gold for years. That divergence is narrowing fast. Gold-silver ratio currently 88.1, historical average. 60.1, industrial demand era average. 50.1. Every point that ratio falls means silver is catching up, and it catches up violently. Gold sets the monetary tone. Silver amplifies it. When silver wakes up, it doesn't tiptoe. It sprints. We're watching that wake-up call happen in real time through the arbitrage gap. Asia sees it. The U.S. paper market is being forced to acknowledge it. First 30 minutes. Opening price. Does it gap to close arbitrage? Volume, above or below 15,000 contracts? Dip recovery speed, instant bounce. Physical buying, Shanghai premium. Does it persist or collapse? Rest of the day, support at 30.80. Old resistance, new support. Intraday volatility, fear or repricing. Evening Asia session. Does Shanghai bid higher again? Ignore headlines. Watch price action. Let the market tell the truth. Industrial buyers remember 2020. They remember delivery failures. They remember how fast price moved when inventories disappeared. This feels similar, but the scale is bigger. Industrial demand is 30% higher than 2020. Green energy usage has doubled. Geopolitical fragmentation is real. Supply chains are shorter and leaner. Inventories have less buffer, conquered faster repricing. That's why Shanghai is paying premiums. That's why dips get bought. That's why the gap won't close through price suppression. Physical reality is reasserting itself. Today isn't about guessing the top. It's about recognizing the phase shift. From paper price. Discovery to physical price discovery. From disbelief, acceptance. That transition is always violent. Shanghai already voted with cash, delivery, urgency. New York has to respond. It has no choice. The arbitrage gap is the market screaming, the paper price is wrong. These moments don't announce themselves politely. They happen quietly, early, before consensus forms. By the time everyone agrees, the move is over. Right now, arbitrage is broken. Physical supply is tight. Industrial demand is relentless. That combination is rare, and it doesn't resolve sideways. Stay calm. Stay disciplined. Stay observant. This isn't a day for emotional decisions. This is a day for clarity. And clarity comes from understanding structure, not reacting to noise. If this breakdown gave you clarity on what's happening in silver right now, hit that like button. It helps this analysis reach people who actually care about real signals over hype. Subscribe for grounded, real-time market breakdowns. No panic, no fluff. Just clear thinking in chaotic markets. Today matters. This week matters. Silver isn't whispering anymore. It's shouting, and the market is about to listen.